Hi, and welcome to a new video with Athena Quant. Today, we're going to dive into the hidden math that tries to make sense of financial markets, to find some kind of order in all that mayhem.
So this is the big one, right? The fundamental challenge for anyone in finance is trying to predict what is, by its very nature, unpredictable. So how do the experts even begin to tackle something like that?
Well, it all starts with a search for patterns in the chaos. For decades, the go-to tool for this has been a deceptively simple mathematical model, something called a probability distribution.
To get started, quants reached for a tool they knew and loved, the normal distribution. You've probably seen it before. It's that classic bell curve. And it's so elegant because it's simple. You only need two numbers to describe it, the average, and how much things tend to stray from that average. Now, what makes this model so appealing, so clean, is its beautiful predictability. You can pretty much sum it all up with this simple but really powerful guideline, the 68-95-99.7 rule. So what this rule basically says is that for anything that follows a normal distribution, about 68% of the action happens within one step of the average, 95% within two steps, and almost everything, 99.7%, is within three steps. This tidy, predictable world, especially the part about thin tails, is exactly why it became the bedrock for huge financial models, like the famous Black-Scholes formula.
You can see the appeal, right? It gives us this neat picture of how things should work. But, and this is a huge but, what happens when reality decides it's not going to be so neat and tidy?
And this is where that classic quote from statistician George Box just hits the nail on the head. The world of finance learned a really hard lesson by leaning too heavily on this perfect, but ultimately very wrong model. You see, the normal distribution is useful, for sure, but it's dangerously, dangerously wrong about the one thing that really matters, risk. Just look at this. The model predicts that catastrophic market crashes should be almost impossible. But, as we all know, reality is, well, it's quite different. Just how rare are we talking, according to the model? Well, it predicts that a severe market-shaking crash, what the quants call a 5 sigma event, should only happen once every 3.5 million days. Let that sink in. That's over 9,000 years between major crashes. But we know that's not right. Events of that magnitude, like the 2008 crisis or the 2020 market shock, seem to happen every few years. So what gives? Where does the theory go so completely wrong? The entire reason for this massive gap between theory and reality comes down to a really important concept known as fat tails. In simple terms, fat tails are just the mathematical signature of that wild real-world risk. They're telling us that those crazy, extreme market moves are way, way more likely to happen than the perfect bell curve would ever have you believe.
Okay, so if the classic model is broken, what do we replace it with? We need better tools, right? Tools that are actually designed for the chaos of real markets. So a couple of key upgrades really help fix the problem. The log normal distribution solves one obvious issue. It makes sure asset prices can't go below zero. But the real hero for managing risk is the t-distribution, because it's built from the ground up specifically to account for those fat tails.
And look, these aren't just some abstract academic upgrades. No, they have profound practical consequences for how we actually measure and manage risk in the real world.
So why does this all matter? Well, let's look at a core concept called value at risk, or VAR. Using the old normal model, you might be told the most you can expect to lose on a given day is 1.65%. But the t-distribution, because it accounts for those fat tails, gives a much more realistic warning. It says you could lose up to 2.24%. That's a huge difference when millions or billions of dollars are at stake.
You know, here's a good way to think about it. Relying on the normal model is like using a trampoline as a safety net for someone working on a skyscraper. Sure, it'll work for small falls, but it is completely useless for that one catastrophic plunge that actually matters. And that's really the crucial point. Choosing the right model isn't just an academic exercise. It is the difference between being prepared for the storm and being completely wiped out by it.
This brings us to the fundamental challenge that really defines modern finance. Knowing that every model has its flaws, what's the right balance between trusting the math and maintaining a healthy dose of skepticism?
It's all about respecting the models, but never, ever forgetting the wild reality they attempt to tame. Thanks for watching.